Welcome, everybody, to Trading with Ashley. I am really happy to talk to you about this subject today because it involves how to correct a trade that has worked against you if you are selling options. In today's class, and I'll call it a class because you're going to feel like that you're learning this from the ground up, which is the best way to learn. I'm going to teach you step by step how to roll a sold put that is about to breach your strike price or has breached your strike price. Now, let me lay the foundation for you. When you are dealing with options, you can buy options or sell options. When you buy options, basically that is a directional trade. Now, if you buy a short-term option, that is truly like gambling because you are betting that a stock is going to go up quickly or go down quickly, depending on whether you purchase a call or a put. What I specialize in is selling options. And if you sell a put, I want you to visualize taking a lot of cash and putting that cash up on the table, pushing it towards the broker, saying, hold my cash. I'm putting up the cash to buy one of my favorite stocks, but only if the stock comes down to the price I'm comfortable paying for it. That is what is called selling a put. When you do that, someone on the other end of that trade, they are willing to compensate you in the form of premium. And the reason they're willing to compensate you is you are guaranteeing that there's someone out there that will buy their stock at the price that they're comfortable selling it. So if the stock was to start to drop and drop quickly, they're worried, will I be able to get out of this trade? Will I be able to get enough money and save enough money if my stock starts pulling back? So you, as the option seller, are putting up the cash to guarantee that they will at least get the price that they agreed to sell their stock at to you. It works out great for you because you have more flexibility as the option seller. And what does that mean? Well, let's talk through the dynamics. Let's say that you have agreed to buy a stock. We will call it Trading with Ashley stock. You've agreed to buy the stock at $100. Currently, it's trading at $125. So if the Trading with Ashley stock comes down to $100, you've put up $10,000 in your broker account to buy that stock. Well, what if the Trading with Ashley stock's having a rough day and it pulls down? We're about a few days from my expiration, and it pulls down to, let's say, $90 a share. And now you're feeling like, well, I was okay paying $100 when it was at $125, but now that it's trading under $100, I have decided I really don't want to buy this stock when I'm put the shares at $100 and it's only trading at 90. So in that situation, you can do one of two things. You can go ahead and take ownership of the shares if you are at your expiration date and it's trading under your strike price, at or under your strike price. If you were to do that, then you could hold the shares, wait till they go up again, and then start selling covered calls. That's the wheel strategy. Or you can roll the trade. And what you're doing when you roll a trade, you're basically simply kicking the can down the road, and hopefully you're getting paid to do so because you're going to tie up your money for longer now because you're extending the life of the trade. And ideally, you'll be coming down in strike price, maybe closer to where it's trading at today at $90. Or you might decide, you know what, I'm okay meeting in the middle. I'm okay buying it at 95 if it's trading at 90. And you want to wait to see if you can get that stock a little bit lower than your original trade. So in that scenario, what you're going to do when you roll the trade, it's simply closing down the initial trade. If you had said that you would buy the stock for 100, you buy that contract back. Now, when you buy it back, you're going to be paying more for it in premium than when you opened the trade and you received that cash because the stock has come down from the time that you actually opened the trade. So you can get out of it, but it will cost you. So the goal in a situation like that is you want to go look for another trade that you can sell further out in time that actually will pay you more than the amount you just paid to close out the trade. And that is a successful rolling of a trade. You get paid more premium and you get to lower your cost basis for a stock, which makes the trade safer and it allows you to do more with the position if you're actually put the shares at that lower level. One other benefit to rolling a trade is if you had initially put up $100 a share, so $10,000 for the trade, when you reduce the amount that you're willing to buy the shares for, let's say 95, that is going to release another $5 a share, so $500 in held funds back to your brokerage where you can trade other trades with that. So it only holds the amount of the strike price times 100 in funds waiting for that trade to be filled. Now this video is going to really be helpful to you because I am going to show you how to roll a trade in two different brokerages. I'm going to be using both Fidelity and E-Trade, but I'm also going to show you how to break apart the trade so that it can be more profitable for you. Now, after I show you this in the broker, I want you to realize they have made it convenient for you by putting both legs of a roll together. So when you roll, it's actually two trades in one. You're buying back the original sold put and you are selling a new one further out and ideally lower and getting a credit. But I want you to realize that that is not the most optimum way to roll a trade. And the reason is each part of the trade, part 1 and part 2, will actually give you more premium or make it cheaper to get out of it in different market conditions. So let's talk through the dynamics. If a stock is having a red day, that's the optimum time to sell a put because somebody's nervous that their trade is working against them and they are more willing to buy a put. They're going to pay you more for it if you're putting up the money to guarantee their trade. Okay, so that's established. Now, if you're wanting to get out of the trade and buy back that put, the most optimum conditions to do that is when the stock is actually doing okay. It's moving back up and it looks like that the trade may end up expiring worthless. That's the best time to buy back the sold put. And the reason is you're going to pay less to get out of the trade than if you try to get out of it on a red day. It's going to be more expensive. So how can you use this to your benefit? Well, like I said, the brokers are going to show you how to do it together, but that actually is the broker's benefit. It's to the broker's benefit for you to do the trade together because you're not going to get the best deal on both legs of the trade. But if you break it apart and do what I like to do called the delayed roll, you actually wait for the optimum conditions to buy back the original sold put. So let's say in my example, trading with Ashley stock pulls down to $90. That's actually not the best time to buy it back. You would be better off waiting for the next green day when trading with Ashley stock moves up to, let's say, $95. Now it's a decent time to buy back that $100 sold put. You're going to pay a lot less for that $100 sold put that you're buying back on a green day. So if I were to do that, now I sit patiently and I wait for another red day. Maybe trading with Ashley stock pulls down from 95. When I bought back the original trade, it pulls down to 93. Now that's the best time to go and sell my new position. If I do it that way, I am limiting how much I have to pay to get out of the trade on the initial trade, and I'm maximizing how much premium I get on the new sold put trade. And if you do it that way, you will see that your rolled positions will actually be a lot more profitable on the roll dynamic. But you have to be organized if you're going to do it this way, because you're not doing it simultaneously at the same time. It's best to keep a ledger so you can keep up with how much you received on the initial trade, how much you spent to buy it back, and then how much you're receiving on the new trade that you are selling on a different day. It does take some organization, but believe me, it is definitely worth it, because you can really get some outsized rolled positions for income if you do it this way. We are now in the Fidelity Broker. Let me show you an example of a sold put that might be at the perfect time to actually roll the put. Let's take a look at this Tesla trade. It's a good opportunity to roll it because we're a few days away from expiration. The initial price when I sold the put was $3.95. Now, at the end of the day today, Tesla was trading at $3.93. So it's not very far away from the strike price, but I might worry that Tesla's going to drop a little bit more, so I might want to make my trade a little bit safer by bringing down this strike price from $3.95 and going maybe down to $3.90. Now, to do that, I'm going to have to go out further because this trade was expiring on the 10th. So I'm going to probably have to push it out at least a week, maybe 2 weeks to go down further for a credit. And so part of the convenience factor is having this roll button right here. So what would happen when you roll this? It's going to populate the trade for you. Now, there's a couple of contracts, so we'll look at both of these. And it populates the initial contract. Right here, it says buy to close, and it has the contract $3.95, January the 10th for Tesla, and it's showing you the bid, the ask, and the midpoint for it. So when I buy this back, it's going to cost me $6.22 because the midpoint is usually a good point to consider the roll. Now, it's time to select a new expiration date and new strike price. So let's look at doing both of these together. Now I am wanting to select a new date. So this is January 10th. Let's look to see if we can find January the 17th, if we can find one that will bring us lower in strike price and allow us to get a credit. So $390 would make this trade safer. And look, it looks like I am able to do that because if I buy this one back for about $620, I can turn around and sell a new one lower in strike price for $11.20. So I'm going to get a really nice credit, about $5 for this roll. So that's $500 per contract. So this is an extra $1,000 that I'll be receiving for actually making the trade safer and less risky. The only drawback is I have to wait until the end of next week to see how this trade plays out. So what you look at right here, it says net credit. If you select one that's going to give you a credit, this will populate. If you've selected one that is not going to give you a credit, it will pop up either as net debit or even. But ideally, you'd want a net credit when you roll. So the new amount you put in here, you can populate it with the midpoint. Usually I will do that, and if it doesn't fill, you can adjust this pricing down to accept less for the roll, and usually it will fill. Typically, I make it good for the day, and then when you preview the order, it'll show you everything. So it's right here. It shows you that you will receive $1,000 for this roll, and you're basically kicking the can down the road, and you're going down in strike price. So this would be a very successful roll. The only way to make this better is if you break it apart. So let me show you what that would look like. So here's how this would work if you were going to break the trade apart and do a delayed roll. So when you see these three options right here, instead of rolling, you would select buy to close. Now what's going to happen when you do this? It is going to look at it as simply a closing trade. You won't see the additional leg below because you're simply closing this trade. And if you were to do that, you would keep everything populated just like it's listed here. And you see this right here, this midpoint 622. If you wait to do this on a green day when Tesla is moving up in price instead of down, this $6 to buy back this contract would be less expensive. You'll see it go down maybe to $5. It could go down, $4, $3.50. As the higher Tesla goes, the less expensive this part of the trade is to close. So if you were to wait for a green day, close this down, and then what you do is it's going to release all the cash back into your brokerage account. So in this scenario, it'd be $39,500. Then when Tesla is pulling back again, which does happen, Tesla's a very volatile stock, you would at that point sell the new put next week at that 390 strike price. Let's go take a look at how you would do that part of the trade. You would put in your ticker symbol Tesla at this point. Again, you're going to want to do this on a red day. You're going to select the put. You're going to do a sell to open. You're opening up a brand new trade. And at that time, I had 2 contracts. So if I wanted to stay consistent, I would do the 2. And now when it comes to expiration date, you're going to choose the 17th because that's what we had looked at rolling before. And you're going to select a new strike price. Now, when we looked at the roll, we were doing 390. So if, let's say Tesla does pull back, maybe in the next trading day, it pulls back to 390. Then you could either do a 390 like you initially thought about, or you could go even lower, whatever you're comfortable with. But let's just assume you're going to do the 390. Now here, you're getting that 1127, 1125 right now. But on a red day, when Tesla's actually trading at about 390, this 1120 right here, that is going to go up significantly. It was probably going to be closer to about $15. And so if you were to wait for the right time and then sell this new one, that's quite a difference. So you can see you'd be getting more for this trade when you're selling the new one. And remember, on the earlier scenario, we paid less to get out of the trade. That's the mechanics of a delayed roll, and that is going to make a significant difference in the amount that you receive for pushing this trade further out. Let's go take a look at a trade in E-Trade and see how a roll populates there. Now, E-Trade has a feature that I really like. So you see here we have this put, and it expires on the 17th. Now, it's in significant profit, so it should be just fine. But let's say I decided I wanted to roll it. So when you click roll here on the E-Trade platform, one thing I like about them, they actually find another trade for you that is going to put you in the dynamic of having a credit. So they self-select a trade. Now you can adjust this as you see fit, but at least they are doing the heavy lifting for you and they're coming up with a new trade. Now looking at this trade, it is trading close to the current strike price. It's trading at $22.57 and my strike is $22.50. But the reason this isn't so much profit, even being that close to the money, is that I had put on this trade weeks ago. So time decay is eating away at the value, and that's mine to keep. But let's say I was a little bit nervous thinking, it could go ahead and breach the strike price because we only have another week left. And if I wanted to go down in price, let's say I wanted to go to $20, let's see what happens. If I select $20, now you can start to see that the dynamics change a bit. Now we are dealing with a debit trade. When you select here, you'd have to select debit because you are going to be paying more to get out of the trade than you'll be receiving on the new trade. You see here, we'd be paying $1.18 and we'd only be getting 48 cents for the new trade. So in this scenario, what you'd want to do is you'd want to adjust either your expiration date or your strike price until you get to a credit. I like the $20 strike price. When I go to January, it gets me a little bit closer, but not quite. I'm still in the debit category, and you can see that right here because I'm getting less than what I am spending. And if I move out a little bit further, let's go to February 7th. Now we're getting a little bit closer, but we're not quite there. I'm going to have to go out quite a bit further. I'm going to have to go out to the 14th, it looks like. Okay, finally, I get a credit to go down to $20. And so right here, you change this to net credit, and then the midpoint is 18 cents, but you could put like 20 cents. And usually that'll fill at some point throughout the day. And it shows you down here the proceeds would be after commissions, you're going to get like $100 to go down in strike price. I hope you found that helpful and it opened up your eyes to the mechanics behind rolling and how you can use it to maximize your income. If you like tips and tricks like this and you want to see more of this on a regular basis, a daily basis even, I would encourage you to book a call with my team and let's discuss you becoming part of the Trading with Ashley community. We have a bustling community. It's a learning environment. It's a very positive environment. But most importantly, people are enjoying all the money that they are making and the freedom that making income from selling options has given them. I would love to welcome you into our community. Book a brief call below and you can be trading with us as early as next week. Now, if you liked this rolling lesson, I picked out another lesson for you that I think will help even organize your thoughts even more around selling options. You can watch that right here.